Well, I have with me an extremely interesting guest, Professor Edward Altman. Professor Altman has developed the Z score, which is actually a score that helps you look at a credit strength of a company and tells you whether it will get into bankruptcy, basically measuring a company's leverage, liquidity, solvency, all externally available data, and predicting whether it will get into bankruptcy. So at a time when India has 15% of banking assets as bad loans, I think he is exactly the man we want to hear. Also, Professor Altman would be perhaps the right authority to tell us where is the global credit cycle headed, and are we seeing too much of money available to global corporates as well? Professor Altman, I can't tell you how important it is to hear you at this juncture, both because of Indian reasons and global reasons. But the global question first, sir. Where are we in this credit cycle? It looks like this benign cycle has gone on for 9 years now?
That's correct. We are in the longest benign cycle in modern financial history. I'm talking mainly about the United States, but I think you can allocate that to a good part of the rest of the world. So we are in the 9th year, and the longest before that was 7 years. And a benign cycle needs to be very carefully defined. People kind of have an idea, but I define it as low default rates, high recovery rates if there are defaults, low interest rates and spreads over the government rate charged to lenders and borrowers, and finally high liquidity. If all of those 4 ingredients are here, then you're in a benign cycle, and we are still in it. And the question is, when will it end? And what will be the impact?
That exactly was my next question. You know, when last October or September, we thought that the U.S. 10-year yields went up to 3.1 and higher, and we thought that the Fed would increase rates. It looked like the cycle is going to end. But now it looks like it can go on for another couple of years. What do you think? Where will it end?
Well, I do think it can go on. And it's not really when it will end, but when it does end, what will be the impact is much more important. But probably we are with the benign cycle for at least another 12 months. Many of the economists in the United States and in the World Bank and IMF are saying there's going to be a reduction in growth in the economy, and many are saying a recession will take place perhaps in 1 to 2 years' time. If we have a recession, but even if we don't, but if we have it for sure, there's going to be a tremendous impact on defaults and the size of companies that default, more than perhaps we've ever had, because of the incredible buildup in global debt in the last 9 years.
But do you see any red flags, any risks to the cycle?
Yes, of course. First of all, non-financial corporate debt as a percentage of GDP, so it's like debt to the cash flow of a country, is now almost 100%, whereas 20 years ago it was half of that, and 10 years ago it was a third of that. So it's 2/3 of that. So it's much higher than that. Some countries, household debt has increased dramatically. I just came from Australia. That's one example. Sweden, Norway, Denmark, all of Scandinavia are very concerned with that. So it's the debt levels relative to the ability to pay back that debt that is the real question. And no question, if we have a recession, the ability to repay is going to go down. But we found in some cases that the default rates on company bankruptcies actually starts rising before a recession. And I'm predicting this year that we're going to see an increase in default rates in the United States, more than perhaps we've seen in the last 10 years. But not necessarily not at crisis levels, not yet.
Fine. We'll be happy with at least that prediction of yours, that we're not at crisis levels. But you know, it's 50 years now that 50 years ago you put forth your Altman Z score. What are the key learnings? I mean, there are a lot of corporates watching you, a lot of fund managers watching you, high net worth investors watching you. What are the key lessons that you have learned in the 50 years of applying your model?
Interestingly, we've learned a lot. but still we have defaults, we have bankruptcies. Everybody knows the model, but is not necessarily using it. And they may have other objectives for making loans rather than the Z-score. But the Z-score is totally unemotional. It is a conceptual model that is also empirically based, and our accuracy has been close to 90% within 2 years of bankruptcy. But this is mainly tested in the United States with perhaps still very good levels. I've tested it on Indian companies, and of the 10 companies I've looked at, 9 of them clearly would have been predicted 2 years before, and their ratings were very high 2 years before and 1 year before, which is a real problem.
Oh, that gives me 2 further questions, especially on rating agencies. But why are you here then? Has the market regulator or the banking regulator invited you?
No, it's interesting. My wife was saying she's going to go to a continent that starts in A and ends in A, namely Antarctica.
Okay.
So I said, okay, I'm going to go first to Australia, also A and A. And since I'm already this part of the world, I always love to come to India. I've been here now 5 or 6 times. I find the audience is the most engaged, well-prepared, and enthusiastic, almost from anywhere else I lecture in the world. So I said, it's time for another trip there. And by the way, I also have some contacts here. And so I've given seminars for bankers so far through Kafral and the central bank. The CFA, I'm going to be speaking to the equivalent to the SEC, the SEBI. And then a couple of companies like SRI and one of the rating agencies, Akute, that I'll be talking to. And so I'm here mainly to learn, but also if I can add any value, I'm happy to. And meeting the bankers, etc., has been a very revealing experience.
Well, you may know then that India is having a huge problem of bad loans, which have been recognized much later than they ought to have, and so it's an accumulated problem. What are your observations? At the moment, standing at probably 13% of total outstanding debt for state-owned banks. It's the government-owned banks that seem to have a slightly bigger problem than private-led banks.
Than the private ones. Well, those levels are unsustainable. I've seen before countries that had high growth, as India does. Let's take South Korea back in the late 90s. High growth, but it was mainly financed by cheap debt financing, or relatively cheap debt financing, which got the companies into trouble. If the country cannot bail out the banks with these unsustainable levels, then it's very bad news for the country in the long run. So these NPLs must be reduced, and of course one of the ways to reduce it was with better models and to listen to the models. India, like many countries, has a great history of helping companies, but let's not forget that you need a credit culture. You must listen to the models and not make loans simply because it's going to add to the growth of the country. Korea was growing at 10% a year for 10 years and then almost defaulted in 1997 once the economy went into a bad state.
So the wrongest thing would be for governments to give loan targets to companies, to banks.
Well, it's okay to give some targets, but they have to be realistic ones for what the country can do under normal conditions. But that's correct. If the country says lend at any risk simply to grow the economy, that's a huge mistake in the long run. And I think countries like China found this out to be the case in the early 2000s, maybe again now. And even the United States, but we don't have the incentive talking to banks. In fact, the banks in the United States do one thing that a lot of banks don't do. They write off the NPLs and sell them quickly rather than keep them on the balance sheet, these zombie companies. And that's a mistake.
So would you, in India we don't have, a market for junk bonds. You think that is the biggest problem that doesn't allow banks to recognize distressed loans because they don't find a seller,
Yes,
a buyer.
Well, that is an issue. You need a supply and demand. You want to sell the loans, but you have to sell it at a fair price and have someone to buy it.
Okay.
I understand, however, that you have a new bankruptcy code here,
Yes.
and that's going to facilitate the sale of loans and also hopefully get interim financing for companies to restructure to both Indian and non-Indian, what we call distressed investors, sometimes
Yes.
affectionately called vultures.
Yes.
Vultures play a very important role both in the jungle and in the financial world, because they set a price for these non-performing loans or defaulted companies.
Yes.
You absolutely need them, and it's not just junk bond companies that buy them. It's distressed investors, and that's an area that I've looked at now for over 40 years in the United States. It's a huge industry.
Okay.
They're waiting, by the way, for more
Okay.
distress in the U.S. And so many of them are thinking about coming to India now because that's where the supply is.
Okay.
Just like they went to China back in the early 2000s.
Okay. What would you be speaking what would your advice be to the Indian capital markets regulator?
Well, first of all, I think it's very foolish to limit the companies who can issue bonds to just AA and AAA, the most credit-worthy companies. That limits the growth of the country, and it also limits the yields that investors can get. So what do investors do? They look for yields outside of the bond area,
Yes.
and these are companies that borrow money at high
Interest rates.
ratings and low rates, and then lend it out very risky investments. Why not have companies come to market with a transparent, very important to have a transparent and accurate and objective rating system, and there's some improvement that can be done in any country, including India, in this respect, and have companies at all levels of risk come to the market and let the investor decide whether or not it's too risky or not for their constituents.
Okay.
Junk bonds are a legitimate asset class, 1.7 trillion in the U.S., 3 trillion globally. Why not India?
Okay. Well, we need to find buyers. I guess once you have a buyer, the issuers will come on their own. There isn't a law preventing C-graded or D-graded companies from issuing, but they don't issue because there's no buyer at this point
That's
in
right.
time.
Buyers have to be there, but I'm sure buyers would be there, especially if interest rates for other higher rated companies are no longer sufficient.
Okay.
But we started in the U.S. when there was the same situation in the 80s, and the buyers came.
Okay.
They'll be there.
The other problem I want to ask you is, how do you create a credit culture for SME lending? One of the big problems is even reaching credit to small enterprises in India and then creating a credit culture.
Yes. You have to have a fair risk-return trade-off for investors.
Yeah.
What does that mean? Well, we all know what returns are being in terms of promised.
Yes.
There have to be the realization that there will be defaults, and take that into consideration. And finally, there has to be an objective and credible measure of risk. And that has to be not only done, but made accessible to investors. I have had experience recently in developing a market in Italy called mini bonds for small and medium-sized firms.
Okay.
The mini bond market will only grow and prosper and sustain itself if there is a fair risk-return trade-off for investors. And so they've asked me to develop what's called a Z-score model for mini bond issuers in Italy, 10 to 20 million euros in size, much smaller than a typical bond issue. And so far, it seems to be working. It's the early stages.
Okay.
And I see no reason why it can't happen here in India with the establishment of this credit culture, which means listen to the models, not only listen to the bureaucrats
Okay.
who have other reasons for ratings.
Okay. Yes, we are only now developing public registries where, credit information is going to be made available. We've done, progressed a lot, but a lot more needs to be done in terms of creating the database.
Yes, the databases are really important. I'm hoping to work with some institutions here in India to establish databases or to use existing databases, perhaps from the banks, the credit bureaus, or an international registry, to build models not only for SMEs only, but SMEs by region, SMEs by sector, and so we can have a much more credible failure prediction model or non-failure prediction model for investors to feel comfortable with this new and what's most people believe highly risky sector.
Yes.
By the way, SMEs need to get financing like anyone else, otherwise the country's not going to grow as much as it could.
That's more true of India than perhaps most other countries.
Well, I'm finding that out as I'm here.
Yes. Okay, now finally I want to ask you about rating agencies. What would your advice be? How do we progress? Lately, because the banks were not able to lend high NPAs and not enough capital, the money went to non-bank finance companies and to debt mutual funds, and through that vehicle to companies.
Yes.
Which obviously the mutual funds depended on rating agencies, so a lot of flack now is falling on rating agencies. What would your advice be?
Well, first of all, rating agencies are really important, and they are globally, but they must be totally objective. They must have credibility in the marketplace. Now, from what I've understood about the Indian rating agency industry, first of all, I think in most cases the companies only get one rating. I think that's a mistake. There should be a minimum of two, and the second rating agency should have some differentiating qualities so that's not more of the same, which means that they are using modern techniques rather than the traditional one, and they are not subject to the same potential conflicts of interest that is endemic in this industry. What does that mean? It means for a rating agency to, in addition to traditional methods, use modern methods like models, maybe some of mine or others, to look at it. And if there's a difference of opinion between what the model says and what the rating agency done traditionally says, then ask the question why. And that information should be known to the investment public.
That's right.
There are probably other things that have been recommended, but those are the ones that I thought. Perhaps rotation of rating agencies is also a good idea.
Oh yes, rotational rating agencies. We've already got rotation in auditors. I suppose extending that to rating agencies will help.
That's very perceptive. I was thinking the same thing. Why are auditors asked to rotate? Maybe 8 years is too much, but still it's a step in the right direction, and not rating agencies. By the way, we don't have that in the U.S. We don't have, let's be honest about it. I may be advocating it for India, but I'd also advocate it for the U.S. as well. We don't have it there.
Okay. Well, finally, let me end where we began. What do you see in terms of what the Fed might do? Will it continue with contracting its balance sheet? Because the last jobs data was excellent, over 300,000 jobs. So what would you expect the Fed to do?
Well, they've already said that they expect to slow down on the raising of rates. They're getting close to where they want to be. I think the Fed, whether they admit it or not, are creatures, they're human beings, and they are creatures of observing what is happening in the real economy and also what's happening in the financial markets, maybe even more than people believe. And anytime there's a hiccup, whether it be in the stock market, the bond markets, mortgage markets, and the like, the Fed is less likely to be as aggressive in this raising of rates. And they've shown that even recently when we had a correction in the stock market in the second half of the year, particularly in the last few months. Now it seems to be calmed down. Like you said, the jobs report is sound, so they may have more backbone to raise the rates than they might not have had it if this hadn't happened. But I do believe that it's not the rates situation that's going to cause the next problem.
Oh.
What I think will cause the next problem is a recession on top of this enormous, and I don't want to de-emphasize the importance, enormous increase in global debt, a product of the benign credit cycle, but also a product of low interest rates.
Okay.
And low interest rates breeds risk on. And risk on is fine as long as they stay low and as long as the economies are doing reasonably well and the companies as well. Once that changes, watch out. And so I'm not very happy about the situation. Although, frankly, between you and I love defaults too, because they add data to our model building abilities. And I'm saying that when my students know this, and I kind of have a half a smile on my face when another big one goes under.
Yep, of course. But when jobs are 300,000, then perhaps recession is not around the corner.
That's true. If that continues, the benign cycle could last quite a bit longer.
Okay. Well, on that optimistic note, Professor Altman, pleasure speaking with you, sir.
My
Thank you very much
pleasure
for visiting India and for joining us
Thank
on
you.
CNBC TV 18.